Good morning, everyone. My name is Jadon, and in this session, we'll explore the efficiency of sale and determine whether it is worthwhile investment opportunity or not. So, SAIL stands for Steel Authority of India Limited. These are the contents which we will be exploring in this session. Moving ahead with the introduction part, Steel Authority of India Limited is one of the biggest or largest steel making companies in India and one of the Maharatnas of country's central public sector enterprises. SAIL produces iron steel at 5 integrated plants and 3 special steel plants, especially in eastern and central regions of India and situated close to domestic sources of raw materials. Company's products include pipes, railway products, galvanized products, stainless steel products, wire rods, etc. Some key highlights of SAIL are annual turnover in 2021 to 22 was rupees 1 lakh crores. Market capital is of rupees 33,697 crores. Share price on 14th April 2023 was rupees 81.60 paisa. Also, it is India's largest steel manufacturer and one of the country's 7 Maharatna public sector enterprises. And current market share is around 20% in Indian steel industry. Here we arrive to the key performance indicators of SAIL. So the very first feature or indicator is shareholding pattern. Shareholding pattern is the percentage of shares held by the investors. So Government of India holds 65% of the equity, which means the company is fully owned and controlled by the government. As government has higher stake in the company, we can expect transparency and efficiency in the management. Also, investors have the support of government in this company. When promoters hold a higher stake in a company, it means that they own a larger percentage of company shares compared to other shareholders. This can indicate several things. First, confidence. Promoters may have a strong belief in the company's potential and its ability to generate profits, which is why they are willing to invest in significant amount of their own money. Second, commitment. When promoters hold a higher stake, it also signals their commitment to the company's long-term objectives and success. They are likely to be more engaged and committed to making decisions that will benefit the company's growth and profitability. Last, alignment of interest. When promoters have a significant stake in the company, this interests are more aligned with those of other shareholders. This can create a sense of trust and confidence among investors, which can be positive for the company's reputation and its ability to raise capital in the future. The D/E ratio is a measure of company's leverage or the amount of debt it has relative to its equity. Debt to equity ratio of SAIL is continuously decreasing, which is a positive indicator as the debt is reduced. The lower the debt to equity ratio is, the less the financial risk for a firm. The company is going to be a debt-free company in the upcoming years. As the firm is less riskier, it is advisable to invest in such companies. Investors and analysts often use the DE ratio as an indicator of company's financial health and risk level. A company with high DE ratio may be considered riskier because it has greater amount of debt to pay back, which can increase interest payment and reduce profitability. On the other hand, a company with a low DE ratio may be viewed as financially stable and less risky firm. Okay, return on capital employed. It is a measure of financial performance calculated by dividing net incomes by shareholders' equity. Shareholders' equity is equals to the company's assets minus debt. That's why ROE is considered the return on net assets. As we can see, ROCE is continuously increasing in the case of Tata Steel and SAIL. Increasing ROE indicates that company is able to generate around 25% of what is expected or what is invested. It can be interpreted that capital is efficiently utilized in both the firm. EPS stands for earning per share. It is a financial ratio that measures the performance or profitability of a company on a per share basis. EPS is calculated by dividing a company's net earning by the number of outstanding shares and the common stocks. So, as the earnings per share increases, investors are more likely to invest in such companies. Higher EPS means more profitability, which suggests that company may increase dividend payout over time. A company's EPS is one of the most accessible metrics to determine whether a company is profitable. A company with strong EPS growth is often considered a company worthy of investment. Net profit, which is 3 year CAGR, compound annual growth rate. The 3 year compounded growth rate in the company's net profits helps in determining whether companies have been consistent in growing their earnings over the long run. It is determined based on the appreciation of per share price plus any dividends paid on the shares of common stock during the performance period. So in the case of SAIL, it is increasing till 2022, but in the case of Tata Steel, which is a competitor of SAIL, it decreased till 2021 and then increased in 2022. As an investor, inconsistent and highly fluctuated CAGR is not considered good. Price to earning ratio. The P ratio helps investors determine whether the stock of a company is undervalued or overvalued compared to its earnings. The ratio is a measurement of what the market is willing to pay for the current operations as well as for the company's prospective growth. Companies with low price earning ratio are often considered to be value stocks. It means they are undervalued because their stock prices trade lower relative to their fundamentals. In the case of SAIL, the P ratio is generally low, which means the company is good as per the P ratio and is trading at undervaluation. Return on assets. It tells how efficiently a company uses its assets to generate profits. It is calculated by dividing the company's net incomes by total assets. A company can arrive at a higher ROA either by boosting its profit margin or efficiently using its assets to increase sales. The higher ROA the number is better because the company is able to earn more money with small investment. As you can see in the case of Steel Authority of India Limited and Tata Steel, both companies' ROA is increasing year by year. Hence, it can be said that companies, both companies, Tata Steel and Steel Authority of India Limited, are using their assets efficiently to generate revenue or profits. Net profit margin percentage. The net profit margin, also known as net margin, indicates how much net income a company makes with total sales achieved. A higher net profit margin means that a company is more efficient at converting sales into actual profit. A high profit margin also makes your company more attractive to investors and lenders. As in the case of SAIL, the profit margin is continuously increasing year to year, and we can see the growth in the this graph. ICR, interest coverage ratio. The interest coverage ratio is a financial metric that measures whether companies can pay their outstanding debts. A higher interest coverage ratio indicates stronger financial health. The company is more capable of meeting interest obligations. In the case of SAIL, the ICR is continuously increasing, which means the company is capable of meeting its interest obligations very much. Asset turnover ratio. The ratio compares the company's gross revenue to the average total number of assets to reveal how many sales were generated from every dollar of company's assets. Both of the companies, that it's Tata Steel and Steel Authority of India Limited, were efficiently generating revenues from their assets till 2020. Conclusion. Efficient management of finance is very important for the success of any concern. In this study, we made an endeavor to analyze the financial performance of the two giant companies in the iron and steel industry, that is Tata Steel and Steel Authority of India Limited. We analyzed from a number of directions, example short-term liquidity, long-term solvency, profitability, and above all management efficiency. Current ratio and quick ratio of both the companies are below standard, which may hinder their ability to meet its short-term liability. SAIL uses debt capital more aggressively, but the interest coverage ratio is well enough, so it may not face any untoward situation in the future. Again, its net profit margins are also not satisfactory as compared with the Tata Steel Limited. All of these affects its return on capital employed and earnings per share. Although SAIL follow a liberal dividend payout ratio, but earnings per share is not at all comparable with Tata Steel Limited. So in all the financial aspects, Tata Steel could be judged as better performer than its rivalry, Same. Thank you.